global jitters and the impact on Indian markets and macros. Rana Gupta, the MD of Indian Equities at Manulife Asset Management, is with us. In a bit, we'll get Richard Harris, the CEO of Port Shelter Investment Management as well. Gentlemen, thanks for joining us. Rana, I want to start with you. You know, initially the fall in India was purely domestic driven because of issues like the rupee, the twin deficits, higher crude, etc. Now that has been exacerbated because of the fall that we've seen in global markets. Collectively, do you think the Indian markets and emerging markets are headed lower because of these issues?
Good morning. I think the Indian markets fall also was linked to three of the factors which is impacting all emerging markets, which are oil prices higher than $80, divergent global growth, which means U.S. interest rates are moving higher, and for emerging markets like India, which is a current account deficit, their marginal cost of capital gets plugged to the global cost of capital, which is rising. And the third, of course, is escalating trade war, and that is leading to some currency-related falls. So these three, we need to see these three reverse or partly reverse or some sort of resolution reached before we can say that, emerging markets, including India, that, the cloud is cleared. But for now, these three things are pretty much impacting India and all emerging markets.
Good morning, Rana. But in your world view, are you really factoring any softening from the Fed? Given the purchasing price index that came yesterday from the US, inflation is still indicating 2.8% year on year. So that expectation of lower yields, is that realistic?
So our global economists' view is that Fed will keep hiking, probably another one in this year and two next year. And perhaps they will keep hiking till the time U.S. Yield curve inverts. So, yeah, I mean, U.S. The spot rate, they may go to something like a 3%. So I think that not necessarily that tightness of the monetary policy is to reverse. We spoke about other two factors, including oil prices and also the trade war. If you say, and those are geopolitical, it's very difficult to call them. But for example, if we see some negotiation between U.S. and Iran, some talks in U.S. and China, those two can subside or reverse. The resolution may be reached, which will be very helpful for the risk sentiment and obviously also positive for fundamentals of India, which has a huge current account deficit and a lot caused by crude oil.
What about fund flows into the Indian markets? I mean, we've seen a huge outflow since the start of the year, but now we are seeing some respite, as far as crude, etc. is concerned. Do you think any of that will provide a relief? When do you expect fund flows to return back to the Indian markets?
See, the fund flows will return when they see good return opportunities, and for that, the oil prices need to stabilize. That will give investors some comfort. The trade war related situation to stabilize because that will give emerging market investors some comfort in general. But apart from that, I think if you are referring to equities fund flow, I think also what needs to happen is that globally, I mean, apart from global, the local macro also stabilize, because so far what we have seen is that if you think in terms of policy making, the Reserve Bank of India had focused on inflation and they did not hike rates in this kind of environment. So therefore, that simply means that rupee has to do the heavy lifting. So the rupee has fallen. So one has to see some stability in the currency market for the fund flows to resume, and one has to see some measures from the policymakers to manage the current account deficit, because at $80 crude, at 3% current account deficit, that's really too high. So we need to see some measures to control the current account deficit, and of course, in the short term, a crude fall may provide relief, and that may bring back funds. But fundamentally, I think one would like to see some measures to get a control on the current account deficit, and of course, for the government to stick to its fiscal deficit targets.
Okay, so when would you start buying? With INR at 74.50 and Nifty at 10,000, good enough, you think, for foreign investors, or would they want more?
So at the without going specifically, I think two things I think worth highlighting. Number one is that the price damage has been so much. Obviously, the valuation has become much more reasonable than what it was. So I think that valuation might attract some investors. But I think to get a continuous fund flow, you need sustainability. And that would happen at whatever rupee level. At whatever rupee level, if you see trade deficit per month falling to something like a $15 billion or below, I think that will comfort, because that means your CAD will not grow to more than 2.5, which I think is manageable. And you need to see for example, the highest frequency data point on fiscal deficit, which is GST collection, moving up to something like a 1 trillion plus, because that will give investors comfort. The fiscal deficit, there is less of a problem. I think once you see those things, you will see fund flows on a sustainable basis.
So are you investing in or putting money to work in any emerging market right now? And what's your view, particularly on India? Would you put money here?
I think as far as India is concerned, so in terms of our views, we are, of course, we have this, top-down views, but in terms of it, when you talk about investing, it also married with the bottom-up. I think currently what we are seeing is specific to India. We like the USD earners, like the technology sector, the pharmaceutical. So that is one part we like. Within domestic part of India, we like the corporate banks, because the corporate banks have gone through a huge asset quality problematic cycle, and we believe that they are kind of coming out of it. So that part looks good. And obviously, because the rates are now moving up, and these corporate banks have very high degree of low-cost deposits, that should also help their margins, and those valuations are also very reasonable. So within domestic area, that is one part also we like.
Okay, well, at the moment, the US yields have come down to 3.15 after the earlier this week high of 3.25. Doesn't console you?
So I think one is to see, that stabilizing, because these are very, over last 1-2 months, these movements have been extremely volatile. If you go back 2 months, US yield, if you more look at the US yield curve spread than anything else. If you go back 2 months, it was as narrow as 10-20, suddenly jumped to 30. We need to see more stability. It's too volatile right now, too difficult to take a call whether it has peaked or not. Okay. Because for now, U.S. growth remains good. And if you look at as you were highlighting also earlier, the PPIs remain high. I would also add even the wage pressures remain quite high. So before one takes a call that the yields are falling or rising, one needs to see the wage pressures and the PPIs, those numbers stabilizing.
Absolutely. Take your point, Rana. We are waiting for a lot of data. The trade deficit numbers for September should come perhaps early next week. And let us see if it has at least moved below that $18 billion that we were ticking for the months of August and July. Thank you very much indeed for joining us. And thank you, Richard Harris, for waiting by so patiently. What's your sense, Richard? First, good morning. Not a good morning for stocks. Do you think that we have to wait a while before we see the emerging markets bottom out?
Well, I think as with all of these falls, you do tend to get a little bit impatient and wondering when things are going to turn. Yeah, when you have a correction like this, it usually takes 2 to 3 weeks, maybe even 2 to 3 months for the markets to really feel as if they've got to bottom out and recover. I mean, if we're looking at the US as a guide, and the US is a leader, we have had a pretty good summer. We have had a pretty good late summer, early autumn. And as a result, we've seen falls in some markets like the US and Japan that have only really eroded the gains that we've seen in the last 1 or 2 months. So in that sense, it's not particularly large. But I think that clearly the big spook is the fact that Treasury yields have gone up. And if you think about it, in the last few months, they've gone up pretty well 1/3%. Now, if you look at that over the basis of the last 5 years or so, that's quite a big hit. So it's not really surprising that the markets have reacted negatively to it, just to try and find another level to price at.
It may not be surprising, but the portfolio erosion has been pretty drastic, especially for markets like India. Richard, good morning. The emerging market index is down 15% this year. Do you see a larger correction coming through? And what would the strategy be now? I mean, invest into markets like India or stay away?
Well, what's interesting, too, is if you look at China, China has had a very weak year. And, of course, this has impacted other emerging markets too. The other impact has been the dollar has been quite strong. Now, a strongish dollar has tended to be negative on emerging markets. And if you look at some of the news in some of the emerging markets like Venezuela, Turkey, where they have dollar debt, where the currency has collapsed, Turkey's down by 50%, their debts in dollars have gone up substantially. So you've got some emerging markets that are really in quite difficult situations. Most emerging markets not, but they still reacted to first of all, a higher dollar, which has pulled liquidity out of those markets. And secondly, I do think that the impact of China has had an impact in the minds of investors worldwide.
Okay. Well, the US 10-year yield is now at 3.15. You think emerging markets are going to have a long, say, month-long, quarter-long kind of sell-off? Because, I mean, the expectation is, as you said, one hike in December at least.
Well, yes, I think that we're certainly going to see a continuation of hikes, as your last speaker said. You know, this is what the Fed has said they're going to do. If there's a change in news, if inflation starts doing something different or the economy is slow, I'm sure they will change. But fundamentally, looking at the factors the Fed is looking at, there's been no real change. So I wouldn't really expect any change in policy. I think the best thing that we can do is, at the moment, this looks like a correction. It doesn't look like the start of a very big slide, although some markets like Europe, you know, have not done quite well. So if we're looking at a correction, then I think you just have to look back at the charts on the last year and a half and say that when we have had similar corrections, the market has bottomed out and generally has recovered. Now, whether it recovers to previous levels, you know, we can't tell at the moment. But these sort of corrections do tend to take at least a month or so to work their way through the system. And it may be that from peak to next peak, whether the next peak is higher than the last peak or not, I don't know. But if you're looking at peak to peak, you're probably looking in the region more like just under a quarter. That's looking historically at what markets have been doing over the last few years, well, probably a year or two.
Okay, well, Richard, thank you for joining us and, you know, providing some sane advice in this rather panic-stricken market. But for now, there's no recovery at all. The Sensex still down almost 900 points and the Nifty still down about 270 odd
Sonia,
points.
we should take it with both hands. We've had a monster rally yesterday, and in spite of it, we have not even corrected all that we rose yesterday as far as the mid-caps are concerned. Yes, in the big boys, we have corrected all that we put on yesterday. But what about the correction that we may have to do in sync with other Asian markets? Look at the way Hang Seng has fallen, or any of the markets, between 4 and 6%. Actually, if we look for the week, we've not really fallen much except for the Monday fall. So we should, if we can get away with this kind of a correction, we've done far better than any of the other Asian markets for this week itself. But the point is, will we stop here? Only time will tell, especially the afternoon trades after London opens.